The global financial landscape is often visualized as a series of interconnected skyscrapers. But beneath the surface lies a complex, subterranean network of vaults known as sovereign wealth funds. These entities, holding upwards of $11 trillion in assets, represent the collective savings of nations, built on the back of commodity exports and trade surpluses. In an era of relative stability, they were the silent stabilizers of the world economy, injecting liquidity during the 2008 financial crisis and fueling the growth of Silicon Valley. But the geopolitical climate has shifted. What was once a bridge between nations has become a potential battlefield. Today, the concept of frozen assets is no longer a theoretical risk buried in a legal prospectus. It is a live weapon of economic warfare. When a state's rainy day fund is locked out of the global clearing system, the resulting tremor doesn't just shake government buildings in distant capitals. It vibrates through the 401ks of American workers and the balance sheets of multinational corporations. We are entering a period where the boundary between national security and global finance has completely dissolved, and the implications for the dollar's hegemony are profound. The first cracks in the facade of global financial cooperation began to appear not with a sudden crash, but with a subtle tightening of credit conditions. In the boardrooms of Wall Street and the central banks of Europe, the realization dawned that the risk-free nature of sovereign reserves was a historical relic. When a nation's assets are held in foreign jurisdictions, they are subject to the laws and political whims of the host country. We began to see the credit default swap, CDS, spreads for once. Stable emerging markets begin to creep upward, signaling that investors were pricing in a new kind of catastrophe, the political seizure of capital. This shift triggered a massive flight to quality, but even the safe havens of U.S. Treasuries felt the strain. As exchange rates fluctuated wildly, the liquidity that usually greased the wheels of international trade began to evaporate. The gold standard of the 21st century, the trust that money earned could always be spent, was being fundamentally questioned. This erosion of trust manifests as a silent run on the global financial system. When a sovereign state observes a peer's assets being frozen, it immediately reassesses its own exposure to the dollar-denominated clearing networks. We began to see central banks quietly shifting their portfolios away from liquid Western bonds and toward physical gold or alternative currency baskets. This transition creates a paradox of instability. The very actions taken to ensure national security, sanctioning an aggressor, trigger a deleveraging process that threatens global market depth. Real estate markets in safe haven cities like London, Miami, and New York, long the beneficiaries of sovereign wealth inflows, suddenly face a vacuum of demand. The economic indicators are stark. As these funds withdraw or are locked out, the cost of borrowing for everyday consumers rises. We see a direct correlation between geopolitical tension and the mortgage rates paid by a family in Middle America. The global vault is no longer a place of safety. It has become a pressure cooker, where the steam is the evaporating credibility of the international monetary order. The early warning signs of a sovereign liquidity crisis are rarely found in tabloid headlines. They are hidden in the technical data of the repo markets and the narrowing of bid-ask spreads for government debt. When a major sovereign wealth fund, SWF, anticipates a freeze, it begins a process of preemptive liquidation. This mass sell-off of liquid assets puts immediate downward pressure on bond prices, causing yields to spike. For the average observer, this looks like standard market volatility. But for the economist, it is the smell of smoke before the fire. We see interest rates begin to decouple from central bank targets as the market struggles to absorb the sudden supply of securities. Simultaneously, the exchange rate of the target nation begins a volatile descent. In past cycles, like the lead-up to the 1997 Asian financial crisis, these movements were driven by speculative attacks. Today, they are driven by the existential fear of losing access to the global ledger. When the frozen asset protocol is finally activated, The sudden removal of billions in liquidity acts like a cardiac arrest for the nation's banking sector, halting the flow of credit instantly. To understand the mechanics of this shock, one must look at the balance sheet of a modern nation. When a country's sovereign assets are frozen, it loses its collateral of last resort. In the global market, these funds act as a guarantee for domestic banks and state-owned enterprises. Without this backing, the interbank lending market freezes. We see the overnight lending rates skyrocket as banks refuse to trust one another's solvency. This is the moment the crisis moves from the theoretical realm of geopolitics to the tangible reality of the street. In the target country, the central bank is forced to hike interest rates to astronomical levels, sometimes 20% or 30%, in a desperate attempt to stop the currency's freefall. But these hikes are a double-edged sword. They crush domestic consumption and send real estate values into a tailspin. The frozen assets are not just idle numbers in a database. They are the invisible pillars holding up the local supermarket supply chain. When those pillars are removed, the cost of importing basic goods like grain and medicine doubles overnight, fueled by a currency that no one wants to hold. The contagion effect of frozen assets extends far beyond the borders of the targeted nation, rippling through the complex web of derivative contracts and synthetic instruments that define modern finance. When a sovereign entity is suddenly unable to meet its obligations due to an asset freeze, it triggers a cascade of technical defaults. This is where the credit default swap (SCC) market becomes a primary transmission mechanism for the crisis. Investors who bought protection on a nation's debt find themselves in a legal gray area. Is a freeze a credit event? As lawyers and bankers argue over the definitions, the uncertainty causes a broad retreat from all emerging market debt. We observe a phenomenon known as correlated volatility, where even countries with healthy balance sheets see their currencies devalued simply because they share a regional or economic profile with the sanctioned state. The liquidity drought becomes a self-fulfilling prophecy. In the United States, this manifests as a sudden tightening of the corporate bond market. Large American firms that rely on global investors find that their cost of capital has increased, not because of their own performance, but because the global plumbing of finance is clogged with the ice of frozen sovereign billions. As the crisis deepens, the psychological impact on the global market becomes a permanent structural shift. This is the stage where sovereign risk is redefined from the risk of a country being unable to pay to the risk of a country being allowed to pay. We see a historic divergence in capital flows. Wealthy nations began to realize that the interconnectedness of the global financial system, once touted as a deterrent to war, has been weaponized into a trap. This realization triggers a massive reallocation of assets into non-aligned jurisdictions, creating a fragmented global economy. This fragmentation is inefficient. It leads to higher transaction costs and lower global growth. For the U.S. consumer, this means the era of cheap, imported goods fueled by recycled sovereign wealth is ending. The economic indicators begin to show a sticky inflation, not caused by excessive demand, but by the rising costs of a fractured supply chain and a more expensive dollar. The geopolitical frost doesn't just stay in the vaults. It settles on the balance sheets of every major corporation, forcing a radical rethink of what it means to be a global entity in a world where your assets can be deleted with a single administrative order. To fully grasp the magnitude of a sovereign wealth shock, one must examine the historical parallels of the 1997 IMF crisis in Asia. Back then, nations like Thailand and South Korea saw their foreign exchange reserves dwindle not through political freezing, but through the sheer gravity of market speculation. The result, however, was identical: a total loss of confidence. Today's geopolitical freezes replicate this trauma, but at an accelerated pace. When a country's assets are locked, the current account of that nation becomes a trap. Without the ability to use reserves to stabilize the exchange rate, the local currency enters a death spiral. We see this reflected in the real-time data of the forex markets. A vertical drop in value that erases the life savings of the middle class in days. This is the economic shock in its purest form. It is not a slow decline. It is a sudden, violent reprisal of the laws of supply and demand. As the domestic currency devalues, the real cost of external debt, often denominated in dollars or euros, effectively doubles or triples. The nation is not just frozen out of its savings, it is being crushed under the weight of its own obligations, creating a vacuum that sucks in the entire regional economy. The case of Argentina serves as a haunting blueprint for what happens when a nation is severed from the global financial plumbing. For decades, Argentina has cycled through periods of default and restructuring, but the core lesson remains the same. When a sovereign entity loses the ability to settle international transactions, the domestic economy reverts to a primitive state. We see the emergence of blue markets, unofficial exchange rates that reflect the true, diminished value of the local currency. In this environment, the interest rate becomes an abstract concept, as the central bank loses control over the monetary base. The impact on individual lives is devastating. We see pensioners standing in lines for hours, only to find their monthly checks can no longer buy a week's worth of groceries. This is the human cost of a sovereign liquidity trap. When assets are frozen or inaccessible, the velocity of money slows to a crawl. Small businesses, unable to secure letters of credit for imports, shutter their doors. The resulting unemployment isn't just a statistic. It is a breakdown of the social contract. The state, unable to provide a stable medium of exchange, loses its legitimacy, often leading to civil unrest that further scares away any remaining brave capital. Moving across the Atlantic, the Greek debt crisis of the 2010s offers a different but equally chilling perspective on frozen liquidity. While Greece's assets weren't frozen by geopolitical sanctions, the strict conditionality of the Troika and the temporary closure of Greek banks created a similar paralysis. For weeks, citizens were limited to withdrawing a mere €60 a day. This liquidity starvation demonstrated that even within a modern, developed monetary union like the Eurozone, the flow of capital is a privilege that can be revoked. We saw the dramatic collapse of the Greek GDP, a 25% contraction that mirrored the Great Depression. The lesson for sovereign wealth funds is clear. Dependence on a single external clearing system is a strategic vulnerability. When the off switch is flipped, whether for policy reasons or political punishment, the transition from a first-world economy to a barter-based survivalist state happens with terrifying speed. We observe the real estate market become completely illiquid. Homes that were once valuable assets become liabilities as the taxes remain due, but the cash to pay them has vanished into the digital ether of a locked banking system. The crisis in Turkey provides a contemporary study in currency volatility and the limits of unconventional monetary policy. When geopolitical tensions flared between Ankara and Washington, the Turkish lira became a target of massive market pressure. We saw a dramatic illustration of how perceived political risk can evaporate a nation's purchasing power, even without a formal asset freeze. As the lira plummeted, the central bank's foreign exchange reserves, the sovereign's war chest, were depleted in a futile attempt to defend the currency. This depletion created a de facto freeze. The assets were gone, spent into the void of the market. For the average Turk, the result was a 15% to 80% surge in inflation across various sectors. The economic indicators here tell a story of systemic stress. As the exchange rate devalues, the cost of servicing foreign-denominated corporate debt explodes. This leads to a wave of bankruptcies in the private sector, which then feeds back into the banking system as non-performing loans. The Turkish case proves that in a hyper-connected world, the mere threat of being cut off from the global financial architecture is enough to trigger a self-sustaining economic collapse. Perhaps no modern example is as stark as Venezuela, a nation that sits atop the world's largest proven oil reserves, yet found itself paralyzed by the freezing of its sovereign assets and gold. When international banks and clearinghouses blocked the government's access to its accounts, the state's ability to maintain the petrodollar cycle vanished. We observed the total disintegration of the bolivar, leading to hyperinflation so extreme that prices doubled every few weeks. This is the ultimate geopolitical risk realized. A nation with immense physical wealth that is functionally bankrupt because its digital keys have been revoked. The impact on individual lives transitioned from hardship to a humanitarian catastrophe. Millions fled as the power grid failed and hospitals ran out of basic supplies, all because the sovereign could not settle its trades. The economic indicator of liquidity moved from a financial metric to a survival metric. Venezuela's experience serves as a grim warning to other nations. A sovereign wealth fund is only as valuable as the network that allows you to use it. When that network is severed, the wealth in the fund becomes nothing more than a series of locked zeros and ones. While the humanitarian crises in Venezuela or Argentina may seem worlds away from the glass towers of Manhattan or the suburban sprawl of the American Midwest, the mechanism of contagion is surprisingly direct. The U.S. economy, as the primary host for global sovereign capital, operates on a foundation of recycled dollars. When geopolitical risk causes a massive freeze or a preemptive withdrawal of sovereign wealth, the first casualty is the U.S. Treasury market. For decades, foreign nations have been the largest buyers of American debt, effectively subsidizing low interest rates for U.S. consumers. If these funds are frozen, or if the risk of a freeze causes other nations to stop buying, the federal government must offer higher yields to attract new investors. We see this immediately reflected in the prime rate, the benchmark for everything from credit card interest to small business loans. The impact on the U.S. economy is a hidden tax on every American borrower. As the cost of servicing the national debt rises due to the exit of sovereign buyers, the government is forced to choose between cutting public services or increasing taxes to cover the interest payments. The secondary impact on the U.S. economy centers on the real estate sector and the wealth effect. Sovereign wealth funds are some of the largest institutional landlords in the world, holding massive stakes in iconic skyscrapers, luxury hotels, and commercial hubs across the United States. When geopolitical risks escalate, these funds may face liquidity calls or be forced to divest under the pressure of sanctions. We observe a downward price discovery in the commercial real estate (CRE) market as these giants liquidate their holdings. This isn't just a problem for billionaires. It ripples through the pension funds of American teachers and firefighters who co-invest in these same assets. As property values in major cities like San Francisco or New York face pressure, the local tax base shrinks, leading to reduced funding for public schools and infrastructure. The economic indicators are clear. A 1% rise in global geopolitical risk can translate into a measurable contraction in domestic capital expenditure. The U.S. is not an island. Its prosperity is inextricably linked to the very sovereign capital that is now being used as a tool of international leverage. The disruption of sovereign capital also strikes at the heart of American innovation. Many of the most successful U.S. technology companies and startups have relied on massive infusions of capital from foreign investment vehicles, particularly those from the Middle East and Asia. When geopolitical tensions lead to an asset freeze or heightened scrutiny of these funds, the venture capital faucet begins to run dry. We see this impact in the valuation resets of Silicon Valley unicorns. Companies that were once valued at billions based on the assumption of infinite sovereign liquidity suddenly find themselves in a cash crunch. As these firms scale back, they lay off thousands of high-skilled American workers and cancel research and development projects. This is a direct hit to U.S. productivity growth. The economic indicator of capital expenditure, CapEx, across the tech sector begins to stall. For the individual American, this means the next generation of medical breakthroughs or green energy technologies is delayed. The frozen asset phenomenon creates a chilling effect on the very risk-taking that has historically driven the American dream, proving that when the global flow of savings is weaponized, everyone's future growth is taxed. Faced with the potential for systemic contagion, the U.S. government and the Federal Reserve are forced into a delicate balancing act. The Fed's primary tool, the manipulation of the federal funds rate, becomes increasingly difficult to calibrate when global liquidity is being withdrawn or locked behind political barriers. To prevent a total collapse of the bond market, the central bank may be forced to initiate emergency liquidity facilities, effectively acting as the buyer of last resort for securities that foreign sovereign funds can no longer hold. This expansion of the Fed's balance sheet is a double-edged sword. While it stabilizes the market in the short term, it risks fueling long-term domestic inflation by increasing the money supply. We see the M2 money supply indicators swell, even as the real economy struggles to grow. This intervention also creates a moral hazard on a global scale. If the U.S. central bank always steps in to catch the falling knife of sovereign divestment, it signals to the world that the dollar system is under permanent strain. The policy response is no longer just about managing the domestic business cycle. It is about defending the structural integrity of the global financial architecture itself. The Department of the Treasury plays an even more direct role in this high-stakes game. Through the Office of Foreign Assets Control, OFAC, the U.S. government wields the power to delist or freeze sovereign entities from the financial system. This is the nuclear option of economic diplomacy. However, the response from the Treasury must be surgically precise. If the freeze is perceived as too arbitrary or expansive, it accelerates the de-dollarization trend, where other nations proactively move their reserves into Chinese yuan, euros, or decentralized assets to avoid a similar fate. We see this reflected in the currency composition of official foreign exchange reserves, SOFR, data provided by the IMF. A decline in the dollar's share of global reserves is a direct indicator of diminishing geopolitical trust. To counter this, the U.S. government often implements swap lines, temporary arrangements that provide dollars to friendly central banks facing liquidity crunches. This creates a tiered global system, an inner circle of nations with guaranteed access to liquidity, and an outer circle of at-risk states. For the U.S. economy, maintaining this hierarchy is essential but increasingly expensive, as it requires the U.S. to take on the role of the world's permanent insurer against geopolitical shocks. For the individual citizen, the macro clash of sovereign titans feels abstract until it hits the household ledger. When the frozen asset crisis triggers a spike in U.S. Treasury yields, the most immediate victim is the 30-year fixed mortgage. We observe a credit tightening cycle where banks, fearful of global instability, raise the barrier for entry for first-time homebuyers. This isn't just about higher monthly payments. It's about the total erosion of purchasing power. A family that could afford a $400,000 home at a 3% interest rate finds their budget slashed to $250,000 when rates hit 7%. This creates a lock-in effect in the real estate market, where supply vanishes because homeowners cannot afford to trade up, and demand craters because buyers are priced out. The economic indicator of housing affordability drops to historic lows. On the individual level, survival in this environment requires a radical shift in mindset, moving away from high-leverage debt and toward liquidity-first financial planning. In an era where sovereign billions can be locked away in an afternoon, the individual must treat their personal wealth fund with the same defensive caution as a nation-state under siege. The volatility doesn't stop at the doorstep of the home. It penetrates the retirement accounts and 401k plans of millions of Americans. Most diversified portfolios are heavily weighted in large-cap equities and international index funds, many of which are the primary targets for sovereign wealth fund divestment during a geopolitical freeze. When these massive institutional players are forced to liquidate, we see a correlation spike, where traditionally unrelated assets all begin to fall in price simultaneously. This is the death of the 60-40 portfolio strategy. For the individual, survival means abandoning the set it and forget it mentality. Savvy investors are increasingly looking toward inflation-protected securities and commodities like gold, which lack a centralized counterparty risk. We observe a surge in interest for Treasury inflation-protected securities, TIPS, as a hedge against the fiscal expansion required to bail out a stuttering market. The practical insight for the viewer is clear. In an age of weaponized finance, your greatest risk is not market fluctuation, but systemic lockout. Diversifying across different legal jurisdictions and asset classes is no longer a luxury for the ultra-wealthy. It is a mandatory survival strategy for anyone with a savings account. As we navigate this new era, the concept of sovereign risk has fundamentally transformed from a question of, will they pay, to, will they be allowed to pay? This distinction is the cornerstone of the modern economic documentary. We have seen how the freezing of assets in places like Venezuela, or the pressure on the Turkish lira, can devastate a local population. But we must also recognize that the United States is not immune to the blowback. The weaponization of the dollar is a double-edged sword that provides immense short-term leverage while slowly eroding the long-term foundations of the global financial order. The economic indicators we've tracked, from CDS spreads to mortgage rates, all point to a world that is becoming more fragmented and more expensive. For the individual, the era of passive stability is over. Understanding the plumbing of the global financial system is no longer a niche academic pursuit. It is a vital life skill. We are moving toward a multipolar financial world where liquidity is the ultimate currency. In this environment, the most valuable asset you can possess is not just capital, but the flexibility to move it across a landscape increasingly defined by geopolitical ice. The ultimate test of this new financial order lies in the concept of strategic autonomy. Nations that once trusted the global commons are now building fortress economies. We are witnessing a surge in the creation of new, domestic payment systems designed to bypass the SWIFT network. This is the financial equivalent of building a private road because the highway has too many toll booths and checkpoints. For the U.S. economy, this shift is a direct threat to the exorbitant privilege of the dollar. As more trade is settled in alternative currencies, the demand for U.S. dollars naturally declines, putting upward pressure on domestic inflation and downward pressure on the value of American wages. The economic indicator to watch here is the velocity of M2 money in international markets. A slowdown suggests that the dollar is being hoarded or bypassed rather than circulated. For the individual, this means that the prices of imported electronics, clothing, and energy will become more volatile, no longer buffered by the stabilizing force of a universally accepted currency. The geopolitical ice is not just freezing assets. It is chilling the very concept of global cooperation. This fragmentation leads to a dual-track global economy. On one track, we have the established Western financial architecture, governed by transparency and the rule of law. On the other, a burgeoning shadow financial system is emerging, where sovereign funds and state actors trade in opaque, bilateral agreements to avoid the prying eyes of international regulators. We see this reflected in the rise of commodity-backed trade, where oil, gas, and rare earth minerals are swapped directly for infrastructure or technology, bypassing the banking system entirely. For the United States, this represents a loss of visibility. The economic indicators that policymakers once relied on to gauge global health are becoming less reliable as more activity moves off ledger. We observe a divergence in global interest rates, While the Fed may be tightening to fight domestic inflation, the shadow market may be expanding, creating a global liquidity mismatch. This unpredictability increases the risk premium on all international investments, making it harder for American companies to plan for long-term growth in a world where the rules of engagement are no longer universal. The response from the global central banking community has been a quiet but desperate race for hard assets. We are seeing a historic shift where central banks are no longer satisfied with digital entries on a foreign ledger. They are demanding the physical repatriation of gold. This is a clear indicator of the geopolitical risk we've been discussing. When Germany or Poland moves tons of gold from New York or London back to their own soil, they are signaling a lack of faith in the permanence of the current custody arrangements. This trend directly impacts the exchange rate stability of the dollar. As gold moves from a secondary reserve to a primary one, the traditional petrodollar cycle, where oil-producing nations buy U.S. debt, begins to break down. For the individual, this shift manifests as a permanent increase in the floor of commodity prices. We observe that gold, once viewed as a relic of a bygone era, has returned to the center of the economic stage. The lesson for the viewer is one of tangible security. In a world where digital assets can be frozen by a change in policy, the only true wealth is that which you can physically control or verify through independent, non-aligned networks. As the traditional guardians of the global order adapt, we see the rise of financial sovereignty as a core national security pillar. Governments are increasingly intervening in the private sector to ensure that critical financial infrastructure, from payment processors to cloud storage for banking data, is domestically owned and operated. This shift toward inshoring financial services creates a drag on global efficiency. We observe this in the corporate profit margins of major U.S. banks, which are forced to spend billions on redundant systems to comply with the fragmenting regulations of a fractured world. For the American consumer, this means the era of seamless, low-fee international transactions is drawing to a close. We see a rise in transaction friction, where sending money abroad or investing in foreign markets becomes bogged down in layers of compliance and Know Your Customer, KYC protocols designed to detect sanctioned sovereign wealth. This friction is a hidden tax on the digital economy. The economic indicator of cross-border capital flows shows a marked deceleration, suggesting that the world is no longer getting flatter. It is becoming a series of walled gardens, each guarded by a sovereign gatekeeper. The transition from a globalized financial system to a fragmented one forces a total reevaluation of the safety of the U.S. dollar as a global anchor. For decades, the dollar's value was supported by its utility. It was the only currency you needed to buy oil, grain, or technology anywhere on Earth. But as sovereign wealth funds pull back, we observe the rise of commodity-linked currencies. Nations are increasingly demanding payment in their own domestic tender or in assets with intrinsic value. This shift is reflected in the dollar index, DXY, not necessarily as a sudden crash, but as a period of heightened, unpredictable volatility. For the average American, this means the imported inflation we once thought was transitory may become a structural fixture of the economy. When the dollar weakens, because it is no longer the world's exclusive reserve, the cost of everything from morning coffee to the fuel in your car stays permanently higher. The economic indicator of purchasing power parity suggests that the American standard of living, long buoyed by the world's desire for dollars, is facing its greatest challenge since the end of World War II. In this climate of uncertainty, individual survival strategies must evolve beyond traditional asset allocation. We are seeing a move toward personal economic resilience. This involves maintaining a high level of liquidity coverage, ensuring that a significant portion of one's wealth is not just in the market, but in accessible liquid forms that are not dependent on a single banking jurisdiction. We observe a growing trend in jurisdictional diversification, where even middle-class investors are opening accounts in neutral, stable third-party nations. This isn't about tax evasion. It's about de-risking from the geopolitical crossfire. The economic indicator of retail cash reserves is hitting record highs as people lose confidence in the just-in-time financial system. Practical insights for the viewer include the importance of laddered maturities in bonds and the holding of hard assets that can be liquidated locally. As the macroeconomy freezes, your personal financial agility becomes your most important defense. The goal is to avoid being a forced seller during a liquidity event, a position that has historically led to the total wipeout of generational wealth during sovereign debt crises. The social implications of this frozen financial architecture are profound and often overlooked. As sovereign wealth funds retreat and global liquidity dries up, we see the credit gap widen. Banks, facing higher capital requirements and geopolitical uncertainty, prioritize lending to large established corporations, leaving small businesses and the working poor stranded. We observe a direct impact on social mobility. When the cost of capital rises, the ladder of opportunity is pulled up. This economic stagnation breeds a specific kind of political populism that further fuels the cycle of isolationism and protectionism. The economic indicator of the Gini coefficient, a measure of income inequality, begins to tick upward as those with access to hard assets flourish, while those dependent on digital wages and local credit systems fall behind. This is the ultimate geopolitical risk for a democracy, that the weaponization of finance abroad leads to the erosion of stability at home. Survival in this phase requires a focus on human capital, investing in skills that are portable and globally in demand, independent of the digital vaults that may or may not open tomorrow. As the credits roll on this era of uninhibited global capital, we are left with a sobering realization. The digital vaults of sovereign wealth funds were never truly neutral territory. They were, and always will be, extensions of national power. The frozen assets we have discussed are more than just locked bank accounts. They represent the end of the illusion that finance exists above politics. We have seen how the weaponization of these funds ripples through the lives of individuals, from the cost of a home in the American suburbs to the price of bread in a developing nation. The economic indicators are clear. We are entering a period of higher friction, lower trust, and structural inflation. However, this is also a call to action for the individual investor. By understanding the geopolitical risk inherent in our interconnected world, we can move from being passive victims of these shifts to active managers of our own economic destiny. The frost may be settling on the global financial architecture, but those who remain agile, diversified, and informed will be the ones to weather the coming winter. The era of silent stability is over. The era of strategic resilience has begun. How does this story resonate with you? I'd like to hear your perspective, so feel free to share your thoughts in the comments. If you found this video useful, consider subscribing and giving it a like. Thank you for watching, and I'll see you in the next video.